with Furqan Al-Fatiha. Um, Amin, Ya Rabbal Alamin. Assalamualaikum and good morning to our guest speakers from Kalbis Institute Indonesia, Miss Florencia Irena Lawita and Mr. Maulana Malik Muhammad, our UITM lecturers, Associate Professor Dr. Hasliza Harun, Madam Hafini Suhana, and Miss Nurul Afika Ahmad, and also all UITM students who are here today. Okay, Asal. First of all, I'm just going to introduce myself. I am Dr. Nawal, who is the person in charge for this session. I would like to say welcome to Miss Florencia and Mr. Malena, and thank you for your kind willingness to share your knowledge and expertise with us virtually in this session today. Okay, so before we start, I would like to take this opportunity to actually briefly explain about the collaborative teaching program that we have here in UITM. So collaborative teaching is an effort of using various teaching approaches that involve experts from within and across disciplines from different countries and institutions, along with industrial practitioners, working together to educate, mentor, facilitate, and train groups of students with the aim to empower effective student learning, which is what we are doing in this session today. So, without further ado, I shall pass this session today to our respected moderator, Associate Professor Dr. Hasli Zaharun. You may take the screen.
Okay, thank you, Dr. Nawal.
Welcome.
Firstly, welcome to our speakers, Miss Florencia and Mr. Maulana Malik. We welcome you to this session. Okay, we will have two sessions of a sharing session. So we will start with Miss Florencia for about 50 minutes or 45 minutes to 1 hour. And then we will straight away proceed with the next speaker, Mr. Maulana Malik, for about the same time, 45 minutes. And then remaining 15 minutes, we will open for any question and answer session. So first, I would like to introduce Miss Florencia. She is currently the accounting lecturer at Kalbis Institute. And she has vast working experience in her field, that is accounting, auditing, and finance and tax. So she was the financial controller and personal assistant to the director of PT Cempaka Mega Mandiri. And then she was also the accounting officer for Lipo Group. And prior to that, she was an audit trainee in the financial service industry for Deloitte Indonesia. So with that, I would like to invite Ms. Florencia to start with your sharing session.
Thank you uh, thank you for Dr. Haziza Harun, and thank you for Bu Nawal Esa. Okay, I permission to share screen Doctor and Bu Nawal.
Yes, please do so. Please proceed.
Yeah, thank you. Okay, good morning all. Good morning, Doctor, and good morning, Bu Nawal. And now I want to explain about the business plan for sustainable financial planning. And for the learning objective, first, to explain the definitions of financial. Second, to describe the importance of financial plan. Third, prepare project implementation costs. And fourth, describe the source of finance. First, definition of finance. Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. Finance and the financial thinking are everywhere in our daily lives. Consider your decision to go to college. You thoroughly awaited alternatives such as starting a full-time job immediately, and then decide to college provide to you with the greatest net benefit, more and more individuals are taking charge of their personal finance with the decision, maybe such as when to start saving and how much to save for retirement. And second, whether a car loan or lease is more advantageous. And third, whether a particular stock is a good investment. And fourth, maybe how to evaluate returns of a home mortgage. Our career paths have become less predictable and more dynamic. In a previous generation, it was common to work for one employer your entire career. That would be likely unusual, and most of us will instead change job and possibly even careers many times. With each new opportunity, we must weigh all the costs and benefits, financial and otherwise. Some financial decisions, such as whether to pay $2,000 for your morning coffee, are simple, but most are more complex. In your business career, you may face a question such as, first, maybe you face a question about should your firm launch a new product. Second, maybe you face questions such as which supplier should your firm choose. And third, maybe you want to ask about should your firm produce a part of the product or outsource production. And next, should your firm issue new stock or borrow money instead? And the last, how can you raise money for your startup firm? And next, the task of financial function. Put simply, the finance function within a business exists to help managers to manage. To understand how the finance function can achieve this, we must first be clear about what managers do. One way of describing the role of manager is to classify their activities into the following categories. First, strategic management. This involves developing aims and objectives for a business and formulating a strategy for a long-term plan to achieve them. Deciding on an appropriate strategy will involve the identifying and evaluating the various options available. The option chosen should be the one that offers the greatest potential for achieving the aims of objective and develop. Second, about the operation management. To ensure that things go according to plan, manager must exert day-to-day control over the various business functions. Where events do not conform to earlier plans, appropriate decision and action must to be learned and be taken. And third, the risk management. The risk faced by a business must be identified and properly managed. These risks, which are many and varied, arise from the nature of business operation and from the way in which the business finance. The finance function is concerned with helping managers in each or the three areas identified. This is achieved by undertaking various key tasks. First, financial planning. Financial planning is vital for managers to assess the potential impact of proposal on future financial performance and position. They can
silent. What?
Students, please mute your microphone.
Okay.
Okay. Thank you, Doctor. They can more readily evaluate the implication of their decision if they are provided with estimates of financial outcomes. This can often take the form of project financial statements, such as project cash flow statements, and project income statements. Second, investment project appraisal. Investment in the new long-term projects can have a profound effect on the future prospect of a business. By undertaking appraisals of the profitability and riskiness of investment project proposals, managers can make informed decisions about whether to accept or reject them. This appraisal can also help in priorities investment projects that have been accepted. Third, financing decision. Financing decision, investment for investment projects and other business activities have to be financed. The various sources of finance available need to be identified and evaluated. Each will have its own characteristic and costs. And when evaluating different source, consideration must be given to the overall financial structure of the business. An appropriate balance must be struck between long and short-term source of finance and between the contribution of the shareholders or owners and that of lenders. Not at all of the finance required may come from external source. Some may be internally generated. An important source of internally may come generated finance is profits, and the extent to which these are reinvested within the business rather than distribute to the owners requires careful consideration. And next, capital market operation. For capital market operations, new finance may be raised through the capital markets, which include stock markets and banks. Manager will often seek advice and guidance on how the finance can be raised through these markets. How securities for share and loan capital are priced, and how the markets are likely to rate to propose investment and financing plans. And the last, for financial control. Once plans are implemented, a manager must ensure that the things stay on course. Here, regular reporting of information on actual outcomes, such as the profitability of investment project, the levels of working capital and cash flow, can play a vital role. This can help the monitor performance and detect when corrective action is needed. And next, importance of financial plan. First, I want to steps in the planning process. It is the vital that business develops plan for the future. Whatever a business is trying to achieve, it is unlikely to success unless the future is made on the systematic way. And finance is lies at the heart of the planning process to ensure that a limited resource of a business are used as effectively as possible. And managers must carefully to evaluate the financial implications of each possible course of action. Developing plans for a business involves the following key steps. First, set the aims and objectives of the business. The starting point is to establish the long-term aims and objectives of the business. This will set out what the business is trying to achieve and should provide managers with a clear sense of direction. And second, identify the options available. To achieve the long-term aims and objectives that are set, A number of possible options, like strategies, may be available to the business, and each option must be clearly identified, and which will involve collecting a wide range of information. This can be extremely time-consuming, particularly when the business is considering entering new markets or investing in new technology. Third, we can select an option and develop long-term plans. Each option or strategy must be examined within the context of the long-term aims and objectives that have been set. In selecting the option, the resource capabilities of the business must also be taken into account, and ideally the final choice will play to the strengths of the business rather than expose its weakness. This option choice will become the long-term strategic plan for the business and usually cover a period 3 until 5 years. Fourth, develop short-term plan. Within the framework of the long-term or strategic plan, detail the short-term or tactical plans will normally be planned or prepared for the forthcoming year. This helps to ensure that day-to-day management decisions and actions are consistent with the long-term plans. And for the importance of financial plan, for project implementation costs, the rule of project financial statement, project forecast, the financial statements can play a vital role in the finance two-step of the planning process. That is the evaluations of long-term strategic option, that development of a short-term plan. Both will require a forecast of future financial performance and positions. This means that the project financial statement must be prepared for both long and short-term position or horizons. The length of the time horizon statement, however, will involve or influence that the level detail can be provided. As we shall see later, the longer the time horizon, the more we must rely on simplifying assumption when preparing these statements. And the main or financial statement used for planning purpose are first, a project cash flow statement, and second, the project income statement. Third, a project statement of financial position or balance sheet. When we taken together, they provide a comprehensive picture, a likely future performance and position, where different options are being considered. They enable comparison to be made of the impact of each option on future profitability, liquidity, and financial position. And this should help managers in identifying a most suitable way forward. And next, a source of finance. When considering the various sources of finance available, it is useful to distinguish between external and internal source of finance. By external source, what means thus requiring the agreement of parties beyond the directors of the business. An injection of finance from an issue of new share is therefore an external source, as the agreement of potential shareholders will be needed. And for internal source of finance, on the other hand, arise from decision of the directors that do not require agreement from our parties or from other parties. Thus, retained earnings are source of internal finance, as directors have the power to retain earnings without the agreement of shareholders, even though they have a claim on those earnings. Within each of these categories, we can further distinguish between long-term and short-term of finance. There is no agreed definition concerning each of these terms. A sort of long-term finance will define as one that is expected to provide the finance for 1 year or more. Source of short-term finance, therefore a provide finance for less than a year. As we shall see, sources that are seen as short-term when first used by the business and up being used for long-term. First, external source of finance. The major external source of long-term finance are ordinary shares. Ordinary shares or equity shares represent the risk capital of a business and form the backbone of a business's financial structure. There is no fixed rate of dividend, and ordinary shareholders will receive a dividend only if earnings available for distribution remain after other investors, like preference shareholders and lenders, have received their dividend or interest payments. And if the business is wound up, ordinary shares will only receive the process of asset disposal after lenders and creditors. And in some cases, preference shareholders have received from their entitlements because of the risk of the high risk associated with this form of investment. Ordinary shareholders will normally expect a relatively high rate of return. Although the ordinary stakeholders' potential losses are limited to the amount that they have invested and or agree to invest, the potential returns are unlimited. After preference shareholders and lenders have received the returns, all earnings that remain will accrue to the ordinary shareholders. And thus, while their downside risk is limited, their upside potential is not. And ordinary shareholders control the business through their voting rights, and which give them power to elect the decision or to elect the directors and to remove them from office. From the business perspective, ordinary shares can be useful source of financing when compared with borrowing. It may be possible to avoid paying a dividend, whereas it is not usually possible to avoid interest payments. Second, preference share. Preference share over investor a lower level of risk than ordinary shares. Provided there are sufficient earnings available, preference shares will normally be given a fixed rate of dividend each year. Furthermore, preference dividends will be the first slice of any dividend paid. And if the business is wound up, preference shareholders may be given priority over the claims of ordinary shareholders. Like the business on particular documents of incorporation will state the precise rights of preference shareholders in respect. Next, preference shareholders will offer a low level of return than ordinary shareholders. This is because they carry a lower level of risk, and preference shareholders have priority over ordinary shareholders regarding dividends and perhaps capital repayment. Preference shareholders are not usually given voting rights. Also, this may be granted where preference dividends are in areas. Both preference shares and ordinary shares are, in effect, redeemable, and the business is allowed to buy back the share from the shareholders and at any more. Next, for the share price, which reflects the expected future returns from the share, will normally be less volatile for the preference share than for ordinary share. The dividends of preference share tend to be fairly stable over time, and there is usually an upper limit on the returns that can be received. And preference shares are no longer an important source of new finance. A major reason for this is that dividends paid to preference shareholders, like those paid to ordinary shareholders, are not allowable against taxable profits. Loan interest, on the other hand, is an allowable expense. And from the business's point of view, preference shares and loans are often seen as fulfilling a similar function. And this tax and the tax benefit of loan interest cash, therefore, tip the balance in favor of borrowing. And in addition, interest rates on borrowing have been at historically low levels in recent years. Next, borrowings. Borrowing most businesses are relying on borrowings or loans. We can call as loans, and as well as share capital to finance operations. Lender enter into a contract with the business, which is interest or we can call coupon rate. Dates of interest payment, capital repayments, and security for the loan are clearly stated. If a business is successful, lenders will not benefit beyond on the fact that their claims becomes more secure. And if, however, the business experience financial difficulties, there is a risk that the agreed interest payments and capital repayments will not be paid. To protect themselves against the risk, lenders often seek some form of security from the business. This may be take the form of assets pledged either by a fixed charge or by floating charge. A fixed charge will fix on particular assets held by the business, and whereas a floating charge will float over all of the business's asset, and it will only fix on particularly assets in the event that the business defaults on its obligation. And next, about financial lease, including a sell and lease back arrangement. When a business needs a particular asset, such as a piece of equipment, instead of buying it direct from a supplier, the business may arrange for a bank or other business to buy it and then lease it to the business. The bank that owns the asset and then leases it to the business is referred to as we can call lessor. The business that leases the asset from the bank and then use it is referred to as the lessee. Finance lease, as such an arrangement is known, is in essence a form of lending. This is because had the lease borrow the funds in order to buy the asset, and the effect would be much the same. The assets would be available for use within the business, but there would also be a financial obligation, just as with a leasing agreement. And with finance leasing, legal ownership of the asset remains with the lessor. However, the lease agreement transfers to the lease virtually all the rewards and risks associated with the item being leased. A finance lease agreement will cover a substantial part of the life and of the lease item, and often cannot be cancelled. And next, hire purchase. Hire purchase, or we can call HP, is a form of credit used to acquire an asset. Under the terms of a hire purchase agreement, a customer pays for an asset by installment over an agreed period. Normally, the customer will pay an initial deposit. We can call it down payment, and then make installment payments at regular intervals, perhaps monthly, until the balance outstanding has been paid. And the customer will usually take possessions of the asset after payment of the initial deposit. Also, legal ownership of the asset will not be transferred until the final installment has been paid. An HP agreement will involve in three parts. First, the supplier. Second, the customer. And third, a financial institution. Although the supplier will deliver the asset to customer, the financial institution will buy the asset from the supplier and then enter into an HP agreement with the customer. This intermediary role played by the financial institution enables the suppliers to receive immediate payment for the asset, but allows the customer period of extended credit. Next, securitizations of asset. Securitizations involve bundling together liquid financial or physical asset of the same type so as to provide backing for an issue of bonds. This financing method was first used by US banks, which bundled together residential mortgage loans to provide asset backing for bonds issued to investors. Like mortgage loans held by a bank are financial assets that provide future cash flows in the form of interest receivable. Securitization has spread beyond the banking industry and has now become an important source of finance for businesses in a wide range of industries. Future cash flows from a variety of illiquid assets are now used as a backing for for bond issues, including first, like credit card receipt, second, like a water industry charge, next, like rental income from university accommodation, next for ticket sales for maybe football match or royalties from music copyright, consumer installment contracts, or short term in this context, it is usually taken to mean up to 1 year. The major of external source of short-term finance is bank overdrafts. A bank overdraft enables a business to maintain a negative balance on its bank account. It represents a very flexible form of borrowing as the size of an overdraft can, subject to bank approval, be increased or decreased more or less instantaneously. It is relatively inexpensive to arrange, and interest rates are often very competitive. As with all loans, the rate of interest charged will vary according to how creditworthy the customer is perceived to be by the bank. An overdraft is fairly easy to arrange. Sometimes it can be agreed by telephone call to the bank. In view of this advantage, is it not surprising that an overdraft is an extremely popular form of short-term finance? Banks prefer to grant overdrafts that are self-liquidating, and that is the funds are used in such way as to extinguish the overdraft balance by generating cash inflows. The banks may ask for project cash flow statements from the business to see when the overdraft will be repaid and how much finance is required. They may also require some from of security on amount advance. On a potential drawback with this form of finance is it repayable on demand. This may be pose problems for a business that is liquid. However, many businesses operate for many years using an overdraft, simply because the bank remains confident of their ability to repay, and the agreement suits the business. Thus, bank overdrafts, took in theory regarded as short terms, can in practice become a source of long-term finance. And next, about bills of change. Bills of change is similar in some respects to an IOU. It is a written agreement that is addressed by one person to another, requiring the person to whom it is addressed to pay a particular amount at some future date. Bills of exchange will carry no interest, are used in trading transactions, and they are offered by buyer to a supplier in exchange for goods. The supplier who accepts the bill of exchange may either keep the bill until the date the payment is due, or this is usually between 60 until 180 days after the bill is first drawn up, or present to it to a bank for payment. And the bank will often be prepared to pay the supplier the face value of the bill, less a discount, and will then collect the full amount of the bill from the buyer at the specified payment date. And next, about the debt factoring. Debt factoring is service offered by a financial institution known as a factor. Many of the large factors are subsidiaries of commercial bank. Debt factoring can involve the factor taking over the trade receivables collections for a business. In addition to operating normal credit control procedures, a factor may offer to undertake credit investigations and advise on the creditworthiness of customers. And it may also the protections of approved credit sales. Two main forms of factoring agreement costs, such as first, resource factoring, where the factors assumes no responsibility for bad debts arising from credit sales. Second, non-resource factoring, where for an additional fee, the factor assumes responsibility for bad debts up to an agreed amount. And the last, we discussions about invoice discounting. Invoice discounting involves a factor or other financial institution providing a loan based on proportions of the face value of a business's credit sales outstanding. The amount advanced is usually around 80 until 85% of the value of the approved sales invoice outstanding, and is secured by a fixed charge over the trade receivable of the business. The business must agree to repay the advance within a relatively short period, perhaps 80 or 60 until 90 days. Responsibility for collecting the trade receivables outstanding remains with the business, and repayment of the advance is not dependent on the trade receivables being collected. Invoice discounters refer to deals with larger, well-run businesses. And next, for internal source of finance. Internal source of long-term finance consists of retained earnings. Retained earnings or earnings that are retained within the business rather than to shareholders in the form of dividends represent by far the most important source of new finance for UK businesses in terms of value value of funds raised. And then about the short-term internal source of short-term finance. First, we talk about tiger credit control. By exerting tiger control over amounts owed by credit customers, businesses may be able to reduce the proportions of assets held in this form and so release funds for other purpose. Having funds tied up in trade receivables represents an opportunity cost insofar that those funds could be used for profits-generating activities. And it is important, however, to weigh the benefits of tiger credit controls against the likely cost of lost customer goodwill and lost sales. Second, we talk about reduced inventories levels. This internal source of funds may prove attractive to a business, as with the trade receivables holding inventories impose an opportunity cost on a business as the funds tied up cannot be used for other purpose. And if inventories are reduced, funds become available for this purpose. And however, a business must ensure that are sufficient inventories available to meet likely future sales demand. Failure to do so will result in lost customer goodwill and lost sales revenue. The nature and condition of the inventories help will determine whether it is possible to exploit this form of finance. A business may have excessive inventories as a result of poor buying decision. And this may mean about that a significant proportion of inventories held slow moving or obsolete and therefore cannot be liquidating easily. And the last, we talk about delay payment to trade payables. By providing a period credit, suppliers are in effect offering a business an interest-free loan. And if the business delays payment, the period of the loan is extended and funds are retained within the business, and the business can be a cheap form of finance for a business, although this is not always the case. If a business fails to pay within the agreed credit period, there may be a significant cost. For example, the business may find it difficult to buy on credit when has a reputation as a slow payer. Okay, and this is the last internal source of finance about long-term retail earnings, short-term tiger credit control, reducing inventories levels, and delaying payment to trade payables. And this is enough from me. Thank you for your attention.
Right, thank you, Miss Florencia, for a valuable sharing with the students and us. All right, so we've seen the importance of financial planning. Yeah, because like you said, like I quote yourself just now, financial is key to business success. So all sources of funds allocation will come from the financial and effective financial planning. So we've seen also just now that every managers need to understand the role of finance and then determine the cost, the project cost or project implementation cost. And then next they have to think about where to get the sources of finance, right? And very lengthy and valuable input that you share about the long-term sources as well as the short-term sources. So the Q&A session should be passed over at the end of the session. Yeah, Miss Florencia? Yeah. All right. So we thank you for your sharing. And next, we proceed with the next speaker, Mr. Maulana. Mr. Maulana Malik. He is also the accounting lecturer at Kalbis Institute, and he has also vast experience in his field, accounting. So apart from being a lecturer, previously he was the financial accountant at Petronas Carigali, Indonesia for about 1 year. And prior to that, he is also the account payable officer at the same organization. So Mr. Maulana, I pass over the session to you. You can start with the sharing session with the students.
Thanks, Lisa, and good morning, everyone. It is an honor for me to attend this presentation for today. So maybe before I start it, may I ask about what is the major of the most student in here is from accounting or businesses or management?
All right, so most of our students here are from the built and environment field, and various. Some are from the estate management, some are from quantity survey, yeah, and some are from other programs in the built environment. The entrepreneurship course, the entrepreneurship course is compulsory for them to take for this semester. We have diploma students here in our session. We also have degree students here. And financial is one of the topics that is compulsory for them to learn.
Okay, maybe this is something new for you guys because we will talk about accounting for entrepreneurship. Okay, but before we start, let me share the presentation. So wait for a moment. Can you see me the PPT? Can you show?
Yes, it's good.
Okay, so the topic for today is sustainable finance planning in entrepreneurship. You know, because why entrepreneurship need to have sustained financial planning? Because a lot of people, yeah, young people for today, especially in Indonesia, we know after COVID pandemic, the economic condition is really low. And a lot of people, they are thinking it's better to create their own businesses, starting from small businesses until the medium enterprises as well. And we know this is something maybe quite challenging. Only a few businesses that can sustain maybe in the short term because they don't know how to manage the finance, especially for making a planning for the future for the finance. And first, we should know what is entrepreneurship because maybe a lot of if you are coming from the major background of management, maybe entrepreneurship is not is you already know about entrepreneurship, but the entrepreneurship as well is defined as someone who has ability and desire to establish, administer and succeed in a startup venture along with risk entitled to it to make profit. So in here, we know the objective of entrepreneur is to generate the profit, okay? And obviously, high risk, high income. We know this term for quite a long time ago, right? So when you start doing the business, you already prepare for taking risks to make a profit. So the best example of entrepreneurship is the starting of new business venture. But business you want to open, you can start with the like small businesses, open the coffee shop, buying the cost for your businesses. You want to buy the accessory, or maybe for your cafe, or maybe you want to buy the equipment for your coffee shop. Let's start from zero, from nothing. So you need the businesses to sustain for the future. Okay, so we will talk this more deeply about how accounting can affect the businesses for entrepreneurship. And the entrepreneurs are often known as source of new ideas or innovator, and bring new idea in the market by replacing old with a new invention. We underline in here the key word by replacing old with a new invention. You know, there are a lot of startup over there. For example, if you want to lend money last time, in the recent time, you can just download the apps and lend the money. In Indonesia, it's very common. Yeah, you can lend the money by online. You just show your picture with your ID card. For example, you take a picture and you give it to the lender, and they will give you the money. Yeah, but you need to come to the shop, to the store, for example, to the office of the bank, yeah, of the bank or anything else, and you ask them for borrow money. Okay, but now everything is really simple. Yeah, you can just borrow money whatever you want. Not only that, if you want to buy stock share, you can just download the apps and you can buy stock share anywhere you go. Okay, so this is the key term, the replacing old with a new invention. So the businesses now in here, they are trying to have a competition for making businesses to be easier. And of course, this is something challenging, of course, for especially for you. Yeah, if you want to open the business, you need to be thinking more. For example, like business incubator today. Yeah, a lot of people, they are trying to challenging their idea. What is the good business for them, and what the best to replace the invention, replacing old with a new invention. Okay. Between accounting and the entrepreneurship, yeah, because you know sometimes the business owner asks, why do we need to learn accounting, even though we only just want to have a business? Why do I need to know the knowledge about accounting? Yeah, a lot of businesses, they come into bankruptcy and falling down due to they don't lack of knowledge to learn about accounting. Yeah, because accounting itself show and draw the image of your financial health. If your financial health doesn't sustain, yeah, you just go to bankruptcy. So not only that, accounting also important. For example, if you want to pay the tax, you want to know how much money in your company. So for example, accounting, it is important because businesses report their incomes to the federal government to help determine how much tax they must owe. And this is one of the examples. And also the core purpose of accounting is to help a business track and manage all of its transactions, including expenses and incomes. And you want to see how much income you earn and how much spend from your expenses. Yeah, how much the cost. For example, you open the coffee shop, you want to earn the money from the profit, yeah, your income, and you making pay expense by for example, like accessory for your cafe, like I said before, or maybe you want to buy the beans for your coffee, and you want to know how much money that in your company. And accounting is also important to create a budget and plan for a business financial future. So if you want to know more about how to sustain your business in the future, you want to create a budget for the expense in the future. For example, in the next month, you want to buy expensive coffee machine to replace your old coffee machine. Yeah, but you need to have a budget. So accounting in here also can see, draw an image how much money you have and how do you handle the budget in the future. And also the crucial business decision depend mostly on the financial health of the company. So for example, if the company wants to launch a new brand in another country, having the financial resources or help to either acquire funding or outright fund the project typically dictate where it succeeds. So this is one. This one is related with the expansion to another country. You need to spare your money to expand, and you need to think: does your company have a good financial if you want to expand to another country? You need to see from your accounting again in your businesses. So there are three activity of the accounting. The first one is identification, second one is recording, and the third one is communication. Okay, maybe if you are not coming from the background accounting, this is something new for you, because the first one, we need to select the economic event of transaction. For example, as I said before, I just give you an example from the coffee shop. Yeah, you buy the coffee machine. This selects economic event transaction. So for example, you create a transaction in here, and after that, the transaction, the amount that you spend for buying the coffee machine, you record it in the book. Yeah, you record it, classify, and summarize. So you record it. For example, now there are a lot of accounting information system to easier the user in processing the accounting process. And after that, they will prepare the accounting reports after you record it. And this kind of the form of the communication, yeah, the communication for the internal stakeholder, for the external stakeholder, and to analyze and interpret for users. So the accounting process includes the bookkeeping function. This is a brief explanation about entrepreneurship and accounting. So the learning outcomes for today, hopefully you understand the concept of cash flow. Yeah, maybe you just knew about, you just heard about the cash flow, income statement, balance sheet, and basic financial analysis. But we will talk this later on. But I will not talk in deep because this is related with the high calculation. I just want to give you a simple picture of what is a cash flow, what is income statement, what is balance sheet, and basic financial analysis. So the first one is cash flow. What is a cash flow statement? Yeah, in accounting, there is a cash flow statement. Yeah, I will give you the example of the cash flow statement later. But the first thing that we should know, the cash flow statement is one of the most important financial statements issued by a company, used to manage finance by tracking the cash flow for an organization. So the cash flow statement shows the source of cash and helps you track incoming and outgoing money. We see in here the word of incoming and outgoing money. So the cash going into our businesses and the cash out to our businesses. What is the main difference between cash flow and income? Income statement, we just focus on the profit, yeah, profit and loss. But the cash flow statement, we focus on the cash that we have in our businesses. So we should determine how many the cash in our businesses and how much the money that we spend for the cash out. That is the cash flow statement. So the incoming cash for a business comes from operating activity, investing activity, and financial activity. Yeah, operating activity is daily basis operating activity. For example, you do the business like coffee. Yeah, as I said before, I will just give an example for coffee. Yeah, you buy the coffee, you earn buy the beans coffee, and then you sell your coffee. That's the daily business operating. But investing activity and financial activity, this is related with the stakeholder, yeah, investing, and also loan the money, yeah, and the sum of which is called net cash flow. The statement also inform about cash outflow, expenses paid for business activity and investment at a given point in time. So what is a cash flow statement? So the cash flow statement helps a company make informed decision for managing business operation. The cash flow management tool is an essential tool in determining how well a company can earn cash to pay its debts and manage its operating expenses. Yeah. So for the business to borrow the money, yeah, we know how much debts that we will have, for example, and we know we want to manage how do we pay the money Yeah. So we can see the money, the budget that we have from this cash flow. Yeah, this cash flow is really important and essential to use. Of the statement of cash flow, the first one, the entity ability to generate future cash flow. So, for example, by examining relationship between items in the statement of cash flow, investor can better predict the amounts, timing, and uncertainty of future cash flow that they can on accrual basis data. So there are two bases. The first one is cash basis in accounting. We know that cash basis is the transaction happen in queue when the money we receive is recorded in the book. But accrual basis data is only we select economy of transaction. For example, we want to buy a car, but we pay by credit, yeah, installment. Yeah, we pay by installment. We just select an economic transaction, but we pay it later on, for example, or in the next 2 months. That's the accrual basis data. We just select economic transaction. But if you are buying the car by cash, yeah, the car by cash, full cash, yeah, for example, that's the cash basis data. Okay, so this is the to generate cash flow, future cash flow is how we can manage to pay our debt. Yeah, for example, debt, or maybe how you pay your installment of your car for the following months or the next for the following year. How much money that you will spend. And the next one is the entity ability to pay dividend and meet obligation. So we know in accounting, for investor, we need to pay their dividend. They are already investing our money, and we need to pay their dividend. Okay, the dividend is the profit that we earn, we generate from our businesses by using the money from the investor. So the cash flow is here really important because if company does not have adequate cash, it cannot pay employees. Of course, if you cannot pay employees, there will be trouble in your company. And settle debts or pay dividend, employee, creditor, and stakeholders should be particularly interested in this statement because it will also the flow of cash in business. And the next useful of the statement of cash flow is the reason for the difference between net income and net cash provided used by operating activity, and the cash investing and financing transaction during the period. So net income provides information on the success or failure of a business. However, some financial statement users are critical of accrual basis net income because it requires many estimation. Yeah, many estimation because we estimate how much money that we will spend. For example, if you have you borrow the money, but the interest keep always changing by year, yeah, you need to estimate how many interest that will change over the period. And as a result, users often challenge the reliability of the number, such as not the cash with cash. Many readers of the statement of cash flow want to know the reason for the difference between net income and net cash provided by operating activity. Then they can assess for themselves to the reliability of the income number. And the next one, the cash investing and financing transaction during the period. So by examining a company's investing and financing transaction, a financial statement reader can better understand why asset and liability change during the period. We will talk this later, yeah, about assets, liability, and equity. Yeah. This is the basics, simple of accounting. So the classification of the cash flow, the first one is operating activity, as I said before, is income statement, and investing activity is changes in investment and long-term asset item. For the financing activity, changes in long-term liability and stockholder equity item. So long-term liable is our liability, yeah, responsible to pay money to our investor. It's long-term liability, and stockholder equity is the stock that owned by the owner of the businesses. Operating activity, income statement, the cash inflow, yeah, we know the cash inflow we received from the sale of goods or services, and also from interest received and dividend received. For the cost outflow, so we spend our money to pay supplier for the inventory, yeah, to buy the inventory, and also we pay employee, yeah, for their wages, And also to government for taxes, we also, if you are having a business, you need to pay the taxes as well, and to lender for the interest, and to other for expenses. So this is the operating activity income statement item. And for the classification of cash flow, the next one is the investing activity. So the cash inflow is from sale of PPE. PPE in here is property, plant, and equipment. So that's PPE. And from sale of investment in debt or equity security of other entity. The cash inflow, another one, is from collection of principal on loans to other entities. And the cash outflow to purchase property, plant, and equipment. So this is cash outflow from our cash flow to purchase the property, plant, and equipment, and to purchase investment in debt or equity security, and to loan to other entities. And for the financing activity, the cash inflow is from the sale of common stock. So, for example, if we want have share and we want to sell to our investor, we get the receipt, the share, and we record it as the sale of a common stock. And also the from issuance of debt, bond and notes. And the cash outflow is to stockholder as dividends, to redeem long-term debt or require capital stocks or treasury stock. So this is the significant non-cash activities divided into four. The first one is direct issuance of common stock to purchase assets. And the second one is conversion of bonds into common stock. The next one is issuance of debt to purchase asset and exchange of plant and asset. So the company report non-cash activities in either a separate schedule, bottom of the statement, or separate note to the financial statement. So this is more technical, actually. And the format of the statement of cash flow, there are three, as I said before. The first one is operating activity relating with the daily basis of your having businesses. The first one is direct method. The direct method is for example, the that can trace. For example, as I said before, for instance, like you buy the coffee beans, and then you buy the coffee machine, you buy the truck or car, you can trace, But for indirect method, you cannot trace, like intangible asset. You cannot trace, for example, say paying the salary for your for your employee, you cannot trace. It's intangible. Okay. And the next one is investing activity and financing activity. So what is direct cash flow? Direct cash flow is an accounting method that creates a detailed cash flow statement showing the cash change over an accounting period. And the method lists every transaction or the company's cash flow statement. It is also identifies changes in cash payment and company activity receipts. And also the method solves the financial status, allowing a company to make more informed decision. So there are two, direct cash flow and under the direct cash flow method. So under the direct cash flow method, you subtract cash payments such as payment to supplier, employee, cash receipt, operation, and customer receipt during the period. And also this determines the net cash flow from the company's operating expenses. And you also need to include investing and financing activity after net cash flow from operation when calculating the net change in the company's cash flow for that accounting period. And the indirect cash flow method presents a financial statement that shows the amount of business spends or makes in certain period. It takes the company's net income and adds or subtract difference from non. These usually are changes in the company current liability, asset, and other sources like non-operating losses or gains from non-current asset. So this is the example of the statement of cash flow. If you are recording in the book, this is, so you can see in here, the first one is the cash flow from operating activity. You record it in here, the cash in and cash go out. This is from the operating activity. And for the second one, for the investing activity, you just record it. And also the same with the financing activity. And the result, you know the net increase or decrease in cash. So cash at the beginning period from the last month or maybe from the last year, and then you know the cash beginning, and now you know the cash at the end of period. Okay, so this is the example, the image of the format of the statement of cash flow. Okay, and the next one is income statement. So what is income statement? Income statement is financial statement that show you the company's income and expenditure. It's different with the cash flow. With cash flow, we focus on the cash basis. Yeah. But in here, we focus on the income and expenditure. Maybe these two quite confusing. Sometimes many people still cannot make a difference. What is the difference between flow and income statement? But in here, we underline the key of the profit and loss. Income statements equals to profit and loss statements. It's just the same. Yeah. And this income statement, along with the balance and cash flow statement, helps you understand the financial health of your businesses. If you earn a lot of profit, you have a good financial health for your businesses as well. And the income statement is also known as a profit and loss statement, and the statement of operation, statement of financial result or income, or statement. Okay, and also what is the importance of income statement? So the income statement help business owner decide whether they can generate profit by increasing revenue, by decreasing costs, or both. It also shows the effectiveness of the strategy that the business at the beginning of a financial. The business owner can refer to this document to see if the strategy have paid off. Based on their analysis, they can come up with the best solution to yield more profit. And income statement inform the frequent report. Yeah, so the frequent report is relate with the quarterly or monthly report. It's different with the annual report. Yeah, we just provided it for annually, but frequent report of income statement you can provide it. You can prepare for quarterly or monthly. So because of this, the business owner can investor can track the performance of the closely and make informed decision. And this enables them to find and fix small business problem before they become large and expensive. Okay. And the next one is pinpointing expenses. And this segment highlights the future expenses or any unexpected expenditure which are incurred by the company and any area which are over or under budget. Expenses in here, we know expenses, yeah, including the building, rent, salary, and other overhead costs. And as a small business begin to grow, it may find its expenses soaring. This expenditure might involve hiring worker, buying supply, and promoting the business. And income statement also inform the overall analysis of the companies. This statement gives investor an overview of the business in which they are planning to invest. Banks and other financial institutions can also analyze this document to decide whether the business is non-worthy. So yeah, this is common and basic. Yeah. For example, if you want to borrow the money to the bank, well, the most important thing to do is you need to show your financial health to the bank. Yeah, you see, income statement is one of the basis for the bank to overlook your businesses. How profit you earn, how loss you earn, is it periodically you still earn the money profitably, or maybe you just making loss quite a lot. But also they will see your cash flow. Yeah, are your company will be in bankruptcy? Yeah, that's the worst. Or maybe just your company only in difficult time. Yeah, not only not almost to reach the bankruptcy. Okay, so this is really useful for the bank to see and overlook the financial health in your businesses. And two main groups of people who use the financial statement, the first one is internal and external user. Yeah. So internal user include the company, management, and the board, BOD, yeah, board of directors. Then they will use this information to analyze the business standing and make decisions in order to turn a profit. But for the external user, it's comprised investor, creditor, competitor. Yeah, investor check whether the company is positioned to grow and be profitable in the future, so they can decide whether to invest in the business. Yeah, if you're having a competitor in your business, yeah, for example, you are own the medium enterprises or maybe large enterprises, and you have your competitor, for example, like Apple or Samsung. Yeah, Apple want to know about the income statement for Samsung, they can just access easily from their website. Download the annual report, financial report, and you can see the income statement. Yeah, how much profit they earn. how much the news they generate. Yeah. And this is one of the comparison that external stakeholder will use the information from the financial statement. Yeah, the internal user, BOD, yeah, and finance department, they will use it to see how much money they have, how much the budget they will spend for the future. Yeah. Okay. And these two, internal user and external user, are the two main group people of using the financial statement. And also the creditor use the income statement to check whether the company has enough cash flow to pay off its loan or take out new loan. So competitor use them to get details about the success parameter of a business and get to know about area where the business is spending an extra bit. For example, like research and development spend, yeah, R&D spends. And the basic accounting equation, the company needs to prepare 5 financial statements. Yeah. The first one is income statement, retained earning statement. Yeah, retained earning statement. Retained earning, we retain the earning from our investor, and it will be used maybe for the development of the businesses. So we retain the earning or the dividend. We hold it. Use this for the operational of the businesses before we pay it again, to our dividend, to our stakeholder. And a statement of financial position is the large image or picture of the financial statement. Statement of cash flow, as I said before, the cash basis, and the comprehensive income statement. Okay. So this is an example of the income statement, yeah, profit and loss. We can have a look in here. The revenue we received is the service revenue, 4,700 euro. Okay, and the expenses, there are 4, yeah, 4 expenses. The first one is salary and wages expenses, rent expense, advertising expense, and utility expense. So these 4 are classified as the expenses. Okay, and you know the total expenses is 1,950, and the net income you earn for the period September, yeah, September 30, 2017 is 2,750. Yeah. So this is an example of the income statement. Yeah. But the return earning in here, return earning statement, the return earning September 0, okay, and net income is 270.50. Less by the, yeah, less dividend is 1,300, and return earning September 30 is 1,450. Okay, so we got an income from the investor money, yeah, 2,750. Sorry, and we less the dividend. The dividend is the money of our investor that we need to pay, yeah, based on the agreement of the interest, how much the dividend that agree. Okay, return earning, and this one is statement of financial position as of our balance sheet. Yeah, we call it as OFP or balance sheet. Yeah, as OFP, categorized into 3 actually: asset, equity, and liability. This assets number should be equal with the equity and liability. So if you can have a look in here, 18,050 is the same amount with the total equity and liability. So this is the basic concept of accounting. Assets equal liability at equity, or liability plus equity. This should be the same. Okay, this is the example of the statement of financial position. So SFOP give you an information about your equipment. Yeah, for example, how much equipment that you have, and then also the supplies, account receivable, your cash, and for equity and liability, for example, like share capital, ordinary, retained earning, liability, such as account payable. Yeah, so this is the information that your business have. Okay, this is still the continue of the statement of financial position and statement of cash flow. Maybe it's quite confusing, yeah, if you're not coming from the accounting background, but this is maybe just a simple, brief explanation and understanding that you can learn that the financial position can show you the number of assets that you have equal to equity and liability. Yeah. This is the asset that you have, and this is the equity and liability. And this is for the statement of cash flow. Yeah. Cash flow from operating activity, as we've seen before, yeah. So operating activity, cash received from revenue, cash payment for expenses, and also cash flow investing activity, cash flow from financing activity. Yeah. So we classified into 3 categories. Okay, this is the statement of cash flow. Okay, income statement report the profitability of the company operation over a specific period of time. List revenue first, followed by expenses, and shows net income or net loss. And this does not include investment and dividend transaction between shareholder and the business. Okay, the next one is balance sheet or statement of financial position. So what is balance sheet? The balance sheet provides information on a company resource or assets and its sources of capital. Capital in here is equity and liability or debt. And this information help an analyst assess a company ability to pay for its near-term operating needs, meet future debt obligation, and make distribution to owner. And balance sheet is one of several major financial statements you can use to track spending and earning. Also, cash statement calls as a statement of financial position. A balance sheet shows what your company owns and what it owns through the data listed. It displays this information in terms of your company, asset, liability, and equity. So the basic equation the basic equation underlying the balance sheet is asset must be equal with the liability plus equity. Yeah, this is the basic equation that always be used by the accountant around the world. Everyone, if you are learning about accounting, they need to know this the basic equation: asset equal liability plus equity. And the basic equation: assets are any item of your business own, and liability are payment your business needs to make. Equity is the amount your business's shareholder own. On balance sheet, the assets are ideally equal to or balance out the liability and the equity. And analysts should be aware that different type of asset and liability might be measured differently. For example, some items are measured at historical cost or variation thereof, and other at fair value. And understanding of the measurement issue will facilitate analysis. And the balance sheet measurement issues are closely linked to the revenue and the expense recognition issues affecting the income statement. Okay, there are two primary types of asset: current and non-current asset. Yeah. The current assets are items your business has acquired over time that will be used up or converted into cash within 1 year. Yeah. And or one business cycle of debt on the balance sheet. So for instance, like prepaid insurance, account receivable, temporary investment, cash, inventory, and liability are considered current asset. Different with non-current asset, normally this is not converted into cash within 1 year. This is more likely more than 1 year. Okay, are any asset, fixed asset, or item of your business's own? Things that falls into this category are office equipment, building, property, land, long-term investment, stock, and bond. Office, building, property for long-term. Yeah. So this is categorized and classified as non-current asset. Okay, the next one is current liability. Current liability represent payment obligation your company has to pay within 12 months of the date on the balance sheet. For example, an outstanding bill to an equipment supplier could be a current liability, as could salary payable and income tax payable. So this is the deadline, maybe has to pay only within 12 months of the date on the balance sheet. But non-current liability are amount your company has more than 1 year to pay. And bondholder and bank debt are considered non-current liability. You and your accountant can identify the liability on balance sheet by looking for the word payable. Again, this liability are some of the sources of your company's asset. Yeah. So the difference between current and non-current is the basis of the 12 months compared with the more than a year. Another one is equity. Another asset of source is equity. If you are the sole proprietor of your business, this is referred to as owner equity. So if your business is a corporation, equity is called stakeholder equity. And when all liability are subtracted from your company's asset, the result is equity. And equity is made up of paid-in capital and retained earning. Paid-in capital is the amount each shareholder initially paid for his or her stock. Retained earning refers to the amount of money your business didn't sell to shareholder and to itself. Okay, so we want to know how to read the balance sheet. So we know the basic equation in here: asset equal liability plus shareholder equity. Yeah. Assets include total current asset and all other assets. And total current asset in here include the cash equivalent, account receivable, assets being sold. Yeah, we put asset in here, yeah, on the top of the balance sheet. And the liability includes total current liability and all other liability. Yeah. And the shareholder equity generally includes preferred stock value, common stock value, the total equity value, par value, yeah, if the company issues bond, and return earning. So we put everything here in equity, in equity, yeah. So asset must be equal with liability and equity. And this is an example, yeah. In the balance sheet, in here we can see the total asset 21,810 must be the same with here, with this, yeah, total liability and owner equity. Okay, so this is asset, liability, and owner equity. Okay, why balance sheets is important? Because balance sheets are critical document because they keep business owner informed about your company's financial standing. So this is the example from magazine. Yeah, in magazine pointed out that many business owners fail to recognize their companies are in trouble until it's too late. This is because some business owners are not examining their balance sheets. Typically, if the ratio of your business asset to liability is less than 1, your company is in danger of going bankrupt, and you have to make some strategic move to improve its financial health. So why are balance sheets also important? Because this is document let banks know if you need for any loan or credit. And this is also balance sheet help current and potential investors better understand whether their funding will go and what they can expect to receive in the future. And also investors appreciate business with high cash asset as this insinuates a company will grow and prosper. And balance sheet is a snapshot of a business financial record at a given date. The total of the owner equity is the book value of your business as at date. This report helps a small business owner quickly understand what their business is worth. And balance sheet can help you identify trend in your business finance, particularly when it comes to relationship with customer and supplier. So balance sheet is like you want to see comparing from the over the period. From last period, you compare with the period. How much the equipment you have, how much the asset you have, how much the liability you have. You can compare it from last period to current period. The next one, the last one is basic financial analysis. So why basic financial analysis? Financial health is one of the best indicator of your business's potential for long-term growth. So for example, the Federal Reserve Bank of Chicago recent small business financial health analysis indicates business owners knowledgeable about business finance tend to have a company with greater revenue and profit, more employee, and generally more success. So the knowledge about financial analysis is important, but how we can determine, how we know to find the financial analysis. Everything is already prepared and provided in the financial statement. We just need to find the amount and we need to calculate to get the financial ratio of financial analysis. There are 5 key of financial ratio. The first one is revenue. The second one is profit. The third one is operational efficiency. The fourth one is capital efficiency and solvency. And the last one is liquidity. Okay, a proper analysis consists into 5 key areas. The first step toward improving financial literacy is to conduct a financial analysis of your business. And a profit analysis consists of 5 key areas. It's containing its own set of data point and ratio. So the revenue obviously probably your business main source of cash, the quantity, quality, and timing of revenue can determine long-term success. So in here we see there are a lot of ratio. Yeah. To find the revenue growth, you need to calculate the revenue this period from your financial statement to revenue less period divided by revenue less period. Yeah, you need to less this one. Yeah, revenue this period less the revenue last period. After you get the number, you divide it by revenue last period. So when calculating revenue growth, don't include one-time revenue which can distort the analysis. So you want to know the revenue growth, yeah, from this period to the last period, yeah, and the result, you can see the trend whether your revenue is in good situation or not. And the revenue concentration, this is the calculation. Revenue from a client divided by total revenue. So for example, if a single customer generates a high percentage of your revenue, businesses could face financial difficulty if this customer stop buying. No client should represent more than 10% of your total revenue. And revenue per employee, revenue divided by average number of employee, and this ratio measures the business productivity. The higher the ratio, the better. Many highly successful companies achieve over $1 million in annual revenue per employee. Again, all this number of analysis, you can get this from the annual report of financial statement of position or balance sheet. Okay, now we want to know about the profit. Yeah, of course, if you cannot produce a quality profit consistently, your business might not survive in the long run. So we should know about how do we analyze the profit. The first one is gross profit margin. Yeah, revenue minus cost of goods sold divided by revenue. This is to know, yeah, to obtain the information about gross profit margin. A healthy gross profit margin allows you to absorb stocks, the revenue, or cost of goods sold without losing the ability to pay for ongoing expenses. And the next one is operating profit margin. The formula is revenue cost of goods sold revenue minus cost of goods sold minus the operating expenses, and the amount on the result divided by the revenue. And net profit margin, revenue minus cost of goods sold minus operating expenses minus all other expenses and divided by revenue. So this is the important ratio, yeah, for the profit side: gross profit margin, operating profit margin, and not net profit margin. And the next one is operational efficiency. Operational efficiency measures how well you are using the company resources. A lack of operational efficiency leads to smaller profits and weaker growth. So account receivable turnover formula, net credit sales divided by average account receivable. And this measures how efficiently you manage the credit you extend to a customer. A higher number means your company is managing credit well. A lower number is a warning sign you should improve how you collect from customers. And for the inventory turnover, cost of goods sold divided by average inventory, this measures how you efficiently manage your inventory. Of course, the higher number is a good sign, but the lower number, vice versa, means you either are not selling well or producing too much for your current level of sale. This one is quite important. Yeah, if you are your business producing a lot in manufacturing area, you want to have a look for the inventory. Yeah, and this is really important. Okay. And the next one is capital efficiency and solvency. Capital efficiency and solvency are of interest to lender and investor. We need to find the formula here. First one is return on equity, and this represents the return investor are generating from your business. And for the debt to equity, the formula is debt divided by equity. The definition of debt and equity can vary, but generally this indicates how much leverage you are using to operate. Leverage should not exceed what you're reasonable for your business. And the last one is liquidity. Liquidity analysis address your ability to generate sufficient cash to cover cash expenses. No amount of revenue growth or profit can compensate for pure liquidity. So the formula is current ratio, current asset divided by current liability, and this measures your ability to pay off short-term obligation from cash and other current assets. A value less than 1 means your company doesn't have sufficient liquid resources to do this. A ratio above 2 is the best. And the interest coverage, earning before interest and taxes divided by interest expense. And this measures your ability to pay interest expense from the cash you generate. A value of less than 1.5 is cause you for concern to lender. Okay, maybe it's quite confusing, yeah, a little bit calculation. But in here we need to be more practical. It's about the technical. You need to practice by looking the financial statement of position in the businesses, and you take all the amount, for example, like current asset, yeah, the number of current asset. You take the amount and divide it by the current liability, and you get the current ratio for the liquidity. Yeah. Okay, the basis for comparison, the first basis is your company past to determine if your financial condition is improving or worsening. Yeah, so you want to know the financial condition, whether it's improved or getting worse. And typically the past 3 years of performance, for example, is sufficient, but if access to all the data is available, you should use that as well. Looking at your past and present financial condition also helps you spot trends. If, for example, liquidity has decreased consistently, you can make change. The second basis is your direct competitor. This can provide an important reality check. Having revenue growth of 10% annually might sound good, but if competitors are growing at 25%, it highlights performance. And the final basis consists of contractual covenants. Lenders and investors and key customer usually require certain financial performance benchmark. Maintaining key financial ratio and data point within predetermined limits can help these parties protect their interests. And in conclusion, in order to create sustained business, it is very important to ensure the financial well planned and managed by the entrepreneur. And accounting, yeah, help business to forecast the company future plan. Cash flow, income statement, balance sheet, and financial ratio help the business's potential for the long growth. And also, this show the picture of financial condition in the business and to help businesses in making decisions. Okay, and that's all from my topic for today. Yeah, thank you very much. So, is there any questions so far?
All right, thank you, Mr. Maulana, for your sharing session. Very relevant because it is the continuation of what Miss Florencia presented just now, shared just now. She's more on the introduction, significance, and benefits of knowing financial planning and financial management, whereas you talk about the details on all those financial statements. Yeah, it looks and sound very technical and full of calculation, especially for our built environment students who are non-business background. But we know that to be entrepreneurs, like it or not, they have to learn about all those financial statements. Yeah, so we have a list of questions here. I will go through it. So the first question is from hang on, is from Alif. Muhammad Alif Rushaidi. He's from AP119, means he is from the Diploma of Building Survey, right? So he asked, what does mostly investors do and how do they start investing their money?
Okay, thank you for the question. So, what does monthly investor do and how do they start investing their money? Of course, it's easy for us investing in money. For example, like me, I also invested in some businesses just using their phone. The objective of investing is you want to get profit, obviously. So when you want to start to do the investing, first you need to see the trend from the financial statement, from the ratio. If the trend is going well, yeah, if the trend is good enough, it will ensure you to invest in that company. But if you know from the last period, from the last 2 years period, the trend is not going well, don't do invest in their company. So the first thing, we look to the financial health of the company as well. Yeah, that's the first basic thing. the very important thing needs to do to invest in the company.
All right, thank you. So, the entrepreneurs or the investors will need to look at the trends of that company before
Yeah.
investing in that company first, before making decision. All right, so the second question is from Danish Firdaus from AP1 as well, build diploma in building survey as well. So he asked, how can how can a newly starting business manage their cash flows efficiently and grow?
Okay. This is maybe how can sorry, the question is how can a newly starting business manage their cash flow efficiently and grow, yeah, if I'm not mistaken. Okay. Cash flow. The first thing, you need to conducting the research first before you open the business. Yeah. You need to see whether your business can sustain or not. And also you need to conducting the research for preparing the cash flow. If your cash flow is not good enough, you will not earn the profit. The first basic thing in here is the cash flow. Cash flow will give you an information for the income statement. When your cash flow, your cash in and cash go out is not stabilized from month to month or maybe yearly or maybe in daily basis, it will affect your businesses. So to manage this, you need to record the cash flow in daily basis. For example, the cash in and cash go out. And you need to learn about your customer, your supplier, your investor, and how you reduce the cost to get your cash inflow. To get your cash outflow is less than your cash inflow. So you need to conduct the research in here. Okay.
Right, thank you. Yeah, so needs to do proper reporting and recording of the cash inflow and outflow. All right, so we move on to the next question by Alia binti Muhammad Afif, who is also from the Diploma in Building Survey. So she asks, can a student set realistic investment goals and create a long-term investment plan?
Okay. So how can a student set realistic investment goal and create a long-term investment plan? Yeah. Set realistic investment goal and create a long-term investment plan. I don't know, maybe in Malaysia, but Indonesia, we have this kind of portfolio. Yeah. In our school, in our campus, also we learn about how to create the portfolio for investing. Yeah. So we think our money, how can we invest in one of the company or two company, and we need to overcome the, for example, in the hard situation, what we need to do in making decision. So to create the investment, the first thing to do, you need to learn how to create the portfolio. Yeah, portfolio, of course, you still need to see the recording, the process, investment, yeah, the information from the investment, yeah, and this one, the result will be in the form of portfolio, and this is really useful to be used for the investor. And if you are there, you can learn it. I don't know. In here we have the application from our phone. We call it by Bibit. Yeah, and the Bibit, you just, for example, you want to buy the stock, yeah, in another company, and once you already buy, you get the information of portfolio. For example, if you are a student, just try to invest in a small amount of businesses in the company. Start from small amount, and you see from the next month or maybe in a year, you can get quite a significant amount of money. For example, this is what I did last time when I studied last time in UK. I just learned that it is important for us to create good investment starting since we are young, since we are student. Yeah, especially everything is easily with the technology. You can just use the technology using your phone, buying stock, investment in other businesses, and of course, start from there. You can get the dividend and interest from your investment. Okay, that's my suggestion. Maybe you can starting from overlook your portfolio. Sorry, the portfolio of the company, any other company. This is if the company is growing well, yeah, you can just invest in their businesses. Yeah. Don't targeting for getting profit in every month. Yeah. Because we know the business is volatile. Yeah. It's always fluctuate in every month. Yeah. But the objective in here, the target is to overcome the inflation. If you are investing in 2000, what happened in 2040? Yeah, you can get the money more interest from the inflation, especially. Yeah, because of the inflation, your stock price will be increased. Your interest dividend also will be increased. So my suggestion: start investing when you are young. When you are young, okay.
All right. So means look at the company's portfolio, look at the current company's financial standing, to what extent they can invest and start small in the investment for students to start with their startup. Okay, so the next question is from Nur Atia. She's also from Diploma in Building Survey.
Hello?
So the question
Sorry,
is,
sorry.
in a
I think
business,
I have problem with my computer. I'm sorry, I'm sorry.
please mute. Yes. Please.
Uh,
So her question is,
can you wait just for a moment, please? Sorry.
are you okay there, Mr. Malwana? Can you hear us, Mr. Maulana?
Hello?
Can you hear us? We can hear you.
Yeah,
All right. Okay.
I'm sorry.
All right.
My AirPod is off, so I need to start.
No problem. All right. So the next question is, in a business, some of us already know that if a company was declared the bankruptcy, it is the responsibility between the share partners to handle it. Both of them need to accept their loss. But the situation is, what if when partner A asks the partner B to pay for the loss, does the partner B have to pay for the loss?
So the partner here doesn't want to pay for the loss here, for example.
Looks like the partner A asks B to pay for all the loss when they are both partners.
Okay. Again, this is back again to the agreement between two partners in the beginning. So if you want to have a partnership with another company, with another businesses, you need to face the risk if you are getting lost. And the agreement in here, once you are already getting in the situation when you facing the bankruptcy, yeah, this you cannot run from it. Yeah, you just need to face it. And if you are not paying for the loss, for example, your partner doesn't want to pay for the loss, and or maybe he take care of the loss that he wants, yeah, or maybe sorry, if the partner want to pay all the loss, it's okay, yeah. But again, this is only because we have the agreement in the beginning. So the best thing in here we need to do is ensure the contractual agreement in the beginning. So is it common maybe because in the business nowadays, the loss maybe can be shared. It can be shared. Whether the company A want to share the 50% of the loss, or maybe the company B want to share the loss for the 50% again. Is it good? But if we don't keep the promise, we don't stay with the agreement, they will sue us, of course. And this is need to avoid. Okay. So the best thing in here, we need to ensure the agreement in the beginning about the loss concern.
All right. So means, yeah, back to the agreement. That's why it is compulsory for partnership to have to develop and to formulate their own agreement. All right. Next, moving on to the next question from Khair Fansuri. All right, from Diploma in Building. Yeah, this time Khair is from Diploma in Building. So his question is, what other external sources of finance other than debts that can be used to support a business?
Of course, investment to support the businesses. Okay. We attract our investor. If you ever seen the TV show, the Dragon Dance, if you ever seen the show, Secondance is a representative from the business comes to the investor, yeah, attending the presentation of investor and showing how prospect the business are. And this is really important. If you are having a good prospect business, your investor want to invest in you. So that's why the startup, the new venture, they are trying, challenging themselves to create a new invention to attract the investor to invest in our money compared to them. Yeah. That's the. But in here, if we are we get investor invested in our money. We need also to concern about how we pay the dividend as well. Yeah, and if we want to not, if we can also hold the dividend and we put it in the retained earning, as I said before, and this retained earning will be useful for the operating business for the future as well. Once we already earn the profit from retained earning, we will pay this dividend after we earn the profit from the retained earning. So again, the best thing to do is we find the investor first. We attract our investor. We're trying to get the investment. That's the best thing to do.
All right. Okay, so investors to help support providing the fund for the company. So next one is from Alia Maisara from Diploma in Building Survey. Will depreciation affect cash flow?
Depreciation affect cash flow, of course. Yeah. If you are having for example, the cash in, yeah, for example, you buy the building property, plant equipment, and we record it as in cash in and cash flow. We will see the depreciation of the building because building always have depreciation. It's different with another nature economic of transaction. But for example, like you buy a vehicle, truck for your business support, it will have affecting the depreciation of in cash flow. So when the cash go in, you need to realize how much depreciation will affect in the future. Because in accounting, we need to calculate the depreciation using several methods, like straight line method or maybe another method. We calculate it first, and then we deduct the number to yearly by year. For example, the price of the car will decrease $100 from $3,000 for each year. Then we need to deduct every year until the price of the depreciation of the car is zero. And with this, maybe in the cash flow, it will not really quite affecting. But in the financial statement of position, it will quite affect a lot. Yeah, this is the recorded from the annual basis compared to cash inflow, cash flow out. This is from the daily basis or maybe monthly basis. But it will be affecting quite a lot in financial statement of position. But we need to concern us also when we buy a car or vehicle or truck, we need to calculate the depreciation through the cash in and cash out from the cash flow. I think that's it.
All right, so it does, depreciation does affect, probably indirectly affecting the cash flow. Okay, next question is from Alif Rushaidi from Diploma in Building Survey. Can we grow pre-orders money? What is the risk of the method based on long-term and short-term pre-orders?
Sorry, what's the question? Sorry.
Can we grow pre-orders money? What is the risk of the method based on long-term and short-term pre-orders?
Pre-orders money. What does it mean by pre-orders?
Yeah, I don't know. I think pre-orders means pre-order payment for product that they purchase.
Okay, so it's like prepaid, yeah.
Prepaid, yeah, prepayment. Probably that's what he meant.
Okay, so prepaid payment for the company. Sorry, maybe I will find the question on the text chat room. Yeah.
Okay, we proceed. Yeah, so we proceed for the next question.
Okay.
While you're working on that. Okay, from Amirul, Diploma in Building Survey. I'd like to know do you think is a good way? How do you think is a good way to organize and allocate working capital based on cash flow from previous months?
Okay. Allocating capital from the cash flow from previous month. Again, this is back to the recording process. Yeah, allocating the cash flow from previous month to monthly basis is really important. So we need to record it in the The best thing we need to do, you can record it in daily basis of cash flow. Cash go in and cash go out. To allocating, also you need to record it in proper way. Yeah, monthly basis. If you are disciplined enough for doing it, you can have a good cash flow in your businesses. So cash in can cash go out. Yeah, if we compare to income statement, it's different. Only focus on profit and loss, but income statement for cash basis, we need to allocate. We need to concern this to creating business more sustained. So the working capital also can affect quite a lot in cash on, yeah, and cash flow. And also not only that, working capital also affecting for the internal in our company as well. For example, like salary, we need to pay the wages. Yeah, this determined based on the financial statement of position. But the working capital allocation in here, we need to concern whether the cash in and cash go out need to be properly recorded in the discipline time. Yeah, for example, like daily basis or monthly basis. I think that's it.
All right, okay. The next question is from Johan Mukris. I think a question from Johan Mukris and Akid Aiman, both are from a diploma in building survey. I can probably sum it up together because it is similar. Proper planning investment for the future of a company. I think actually you have explained just now, but probably you can elaborate a bit on that. Proper investment for a company.
How to plan a proper investment in the future for a company. Okay, again, this is almost similar with the question before. Yeah, the proper investment is, again, we need to see the portfolio of the company or the businesses. Okay, yeah, the portfolio is really very important and essential. So if you want to have a proper investment, also you need to spare your money as well. Don't do invest in the big company with the small amount of money. That's quite risky. Yeah. But if you want to be more challenging, if you want to have proper investment, trying to find first have a good investment from your friend. For example, your friend open a business, trying from the small things. Yeah, your friend open a business and you want to invest in their businesses. Yeah, and this will this will help your friends as well. And the agreement between you and your friend can also strengthen the bond. Yes, strengthen the bond. And let's start from the small amount of the investment. But if you are having quite a lot of money in your account, you can just go to the big bank, big company, big business, but with risky, because the the popular business, yeah, the popular company, maybe like big company, they not always get profit. They will not always lose. For example, like last time, my friend invested in one of the big bank in Indonesia. Yeah, even though it's the big bank in Indonesia, still get lost money because he doesn't know how to read the portfolio. He doesn't know how to read the trend of the investment and also the economic condition. So the best thing to do, you see the portfolio of the businesses from a large businesses, and you see the economic condition that will affect the business or sector or manufacturers, for example, yeah, or maybe from the industry of oil and gas, it will be affect with the green sustainably environment or not, and many else to do. So you need to find the circumstances of the environment as well, and you need to see the portfolio of the businesses.
All right, thank you. Yeah, so look at the company's portfolio. So the next question is, if there is from Akhyar Emran from Diploma in Business Survey, in Building Survey, sorry, if there is any miscalculation in the cash flow, would that ruin the company's image? And will the accounts officer or person in charge held accountable and be sued? Miscalculation in the cash flow.
Okay. If the cash flow of company has a miscalculation which has potential of running damage, will the accountant be held accountable and sued? This is rarely happen actually, because if we are having miscalculation in cash flow, this is from the maybe he wants to see the perspective of the big company. Yeah. For the big company, maybe it's normal to have an internal auditor. Internal auditor in here work as an auditor to see the internal financial internal. So if there's miscalculation in here, we got help from the from the internal auditor, and to see whether either we have a miscalculation of the month or not. Once they find the evidence of the miscalculation, they will try to fix it. Yeah, they will ask the finance department. Yeah, to trying to fix. There's a problem with miscalculation. You need to fix this. Okay, this is from the recording on or historical cost. But again, it is rarely happen actually in the cash in and cash go out, cash flow in miscalculation, because everything are easier by using the technology. For example, you get the cash in for buying some product. Yeah, you just record it in the accounting system software, and it's already automatically recorded. Yeah, but you need to get the evidence. For example, the invoicing, the receipt. Once you already get the receipt or invoicing, you can just record it to accounting system software. So there's quite less of miscalculation, and if there's a miscalculation, I don't think there will be until will be sure. Yeah, I don't think that, because again there are a lot of departments that also can support the internal businesses. Not only that, if the internals, if we miss the calculation, also there is help from the external auditor as well, and they will help us to find the evidence or maybe something wrong in our portfolio, or maybe in the investment or in businesses. Okay.
All right, so the internal auditors will filter that first, yeah, and
Yeah.
correct the miscalculation, and will not be up to suing. All right, so the next question from Anis Hanisa, diploma in building survey. She was asking about any resources. She was asking about suggestions from you on any resources or programs available to students entrepreneurship that could provide mentorship, networking opportunities, and financial support. So because they are in Malaysia, I suppose in UITM MASMET have that. But however, if Mr. Maulana have some other suggestions, maybe you can email, give that ideas to Dr. Nawal. So Dr.
Yeah.
Nawal share, yeah, distribute that to our students. And
Okay.
we move on to our last question from Mukri Asfar, diploma in building. My question is how to prepare for the financial emergencies.
Okay, actually, I never heard about the financial emergency before. Yeah, maybe this is the condition where the financial emergency, the company is going in bankruptcy. Okay, I don't know whether how to prepare the financial emergency in accounting. There is no information about financial emergency, but again, the accountant will do the financial statement of position from the, yeah, as I said before, monthly basis or maybe uh, yearly basis. And once they know the business is not going well, or maybe the amount of the businesses is quite risky for having investment, or maybe to buy or to operating again in the future, they will get the sign from this, from the financial statement of position. And once they already know the information from this, they can overcome the issue and the matter that will incur in the future. So the financial emergency, I never heard about this statement, but again, we back to the financial statement of position, the balance sheet, income statement, and cash flow to overtake this problem, and also to overcome the problem that will happen in the bank. For example, if you're the company getting into bankruptcy. Okay.
Right, thank you, Mr. Maulana. All right, so we are at the end of our sharing session already for today. On behalf of the other lecturers organizing this session, I would like to thank Mr. Maulana and Miss Florencia very much on this 2-hour sharing session. Very valuable and insight, have lots of insights for the students and us as well. And thank you to students, all the students who asked questions as well. They are very good questions, and I hope you have learned something from both speakers. So before we end this session, are the students ready to on your camera for a picture? to be taken? If you are ready, then we would like to ask for Fini, Fini to snap the pictures for us. All right. Okay, on your camera, who are ready? For those who are ready. Okay, Hafini. Are we done?
One more, please.
Right. Okay. I think that's it. So all students, please don't forget to assign your attendance with your respective classes. So once again, thank you, Mr. Maulana. I think further communication, you will liaise with Dr. Nawal, right? So with that, we end this session. Thank you to everyone.
Thank you, Dr. Aziza. Thank you,
Thank
Mr.
you,
Thank
Maulana.
you,
everyone.
everyone.
Thank you very much.